Good afternoon, everybody. Quasar Markets. I've got him right here, Dr. Ellman. Ellen, how are you, man?
How you doing, Steve? Always good to talk to you.
Yeah, and you know what? The markets don't seem to care about too much today. They're all over about Europe and Greenland and the world. And you've got a way of protecting us through these covered calls. And I love what you're going to have today. Today is about laddering. And I think other people don't really understand laddering. So I'm going to get out of your hair. I'm going to let you go right to it. And I'm going to bring it to the stage. Here we go.
Okay, thanks, Steve. Welcome, everybody. Today, I'm going to talk about one of my favorite strategies, of course, covered call writing. The other one is cash secured puts. We're going to talk about covered call writing today and what strikes are we going to select. In other words, when we're doing covered calls, we own the stock. Perhaps we just bought it, or perhaps we owned it for a long time. And we're going to leverage those underlying securities to then sell options, in essence, renting out our shares for short periods of time to generate an additional income stream. So what price, what strike price, or what price are we willing to sell our shares for? A price higher than current market value, which is called out of the money, or a price lower than current market value, which is called in the money. Out of the money strikes offer the additional income stream of share appreciation in addition to the premium, two income streams. Now, if you sell an in the money strike, agreeing to sell your shares at a lower price, well, you can't get additional income from share appreciation. But because the premiums are higher, you're lowering your break even point, thereby getting an additional insurance policy. So the in the money strikes are defensive in nature. The out of the money strikes are traditional or more aggressive in nature. Now, when I talk about laddering strikes, what we're talking about is not necessarily using the same strike price for every trade. For example, if we're doing 5 contracts, they don't all have to be out of the money. They don't all have to be in the money. You could do some of each. So I'm using the term laddering now, meaning using multiple strikes for the same underlying stock or ETF with the same expiration date. So Steve, let's move on now to the next slide. And I'm going to define now for your audience, Steve, what is laddering covered call strikes? Well, when we're deciding, hey, what strike should I use? Should it be in the money? Should it be out of the money? How far in the money? How far out of the money? That seems to be a dilemma for a lot of options traders. Well, this is not really a dilemma if we know what our goal is. How much are we looking to generate in terms of percent return when we enter our trade? Now, our final results could be a little higher than that. It could be a little bit lower than that. But what is our starting point? So that's number one. Number two, are we bullish on the market? Are we bullish on the stock? We go out of the money. Are we bearish? Is it an uncertain market like we're in today? Then we might opt for or lean more defensive and go with the in the money strikes. But when we're selling multiple contracts, as I said before, there's no law, there's no rule, no guideline that says they all have to be out of the money or all have to be in the money. You could do some of each. And the percent that you're going to dedicate to out of the money or in the money depends on what your overall market assessment is and what your personal risk tolerance is. So I use the word laddering strikes, which I borrowed from the bond market where they use different expirations for bonds. So that's what I mean by laddering. Let's move on, Steve. So I actually took a trade that I did very recently from one of my portfolios with Kinross Gold Corp, listed on the New York Stock Exchange, ticker KGC. And I executed this trade on 12/29, and it expired on the 2nd of January. So it's a 5-day trade, but actually less than that because of New Year's Day, the market was closed. But we're going to call it a 5-day trade. So here we go, where I laddered strikes, leaning defensive. I've been doing that for most of 25 and still yet into 26. My concern over what's going to happen in the market, so I'm leaning defensive. Here we go. On 12/29, Steve, I bought 1,000 shares of KGC at 27.60. Immediately, I sold 8, not 10, 1/2/26, 5 days out, 27 in the money calls at 92 cents. Now that 92 cents premium is not all profit because we're agreeing to sell our shares 60 cents lower than current market value. That 60-cent component of the 92 cents is called intrinsic value and it's not profit, but it will bring our break-even price point down lower than the out of the money strike will. Okay, but the spreadsheet that I'm going to show you soon will break that down for us. But in any case, the in the money 27 generated 92 cents, $92 per contract. Remember, we're doing 8 of these contracts. Now, the other 2 contracts, I went out of the money and I used the 28.50. Remember, current market value is 27.60. And that generated 25 cents a contract or $50 for the 2 contracts. So I leaned very much defensive. Okay, 4/5 of my trades were in the money and 1/5 was out of the money. So that just shows and reflects my overall market assessment or my concerns as well as my personal risk tolerance. Let's move on, Steve. Okay, so now I don't know how well you could see the screenshot of the spreadsheet. This is the trade management calculator that we created at BCI. An absolute must if you're trading covered calls or cash secured puts. Now, in the top section in the blue cells, I entered the trade. You recall KGC was 27.60, and I sold of the 800 contracts, 8 contracts of the 27 strike, which generated 92 cents. I told you before that's not all profit. Now, below that in the blue cells, the same 27.60 price base, I sold the 28.50 out of the money strike, higher than current market value, and I got $25 per contract on that one for the 200 shares of contract obligation. So those are the trade entries. Now let's look at the section below that, where you see in the red oval that the spreadsheet tells us that there's 5 days in this contract, if taken through contract expiration. Just a heads up that it's actually 4 trading days because of New Year's Day was in there. Now, the red arrow on the left shows that the actual time value on that 92 cent in the money premium, only 32 cents of that was time value. Only 32 cents is actual profit because the other 60 cents were decreasing the value of our shares, agreeing to sell them at a lower price than current market value. So the spreadsheet will break that 92 down into 32 and 60. So the returns are based on 32, not 92. Below that, the 25-cent premium. All right, let's look at the in the bottom section now. In the brown cells, you have your initial time value return in the brown cells for the in the money strike, and that's 1.19%. And based on a 5-day trade, that annualizes out to over 80%. So even though it's like only 32 cents, you go big deal with that. But because it's a 5-day trade, you must annualize these out to get an overall assessment of what you're generating. Here it's over 86%. Now we have downside protection, you see, of 2.17%, and that's in the purple cell. A little hard to read on my screenshot, but that's what it is, 2.17%. Let me explain, Steve, to what the Quasar viewers, what that means. That means we are guaranteed a 1.19% 5-day return as long as KGC does not decline by more than 2.17% in the 5 days. Okay, so that's the downside protection offered to us when we sell an in the money strike. Now let's look at the very bottom row in the pink cells. Those show our time value returns initial of for the out of the money 28.50 strike. And that's a 0.91% based on a 5-day trade that annualizes out to looks like 66% in that pink cell over there. So both of them give humongous annualized returns as our starting point. Now you'll notice in the blue cell at the very bottom that the out of the money strike, in addition to that return, gives us a 3.26% potential for additional returns if the price of KGC goes from 27.60 up to or beyond that 28.50 out of the money strike. Now we know that it didn't, but that was the potential. So you had the potential for that out of the money strike of 0.91%, which is realized, and possibility of another 3.26%. So more than a 4% 5-day return was possible with this particular trade. So you could see just from this spreadsheet the advantage of the in the money strike, very nice return with more protection to the downside, and the out of the money strike, very nice return with the potential for a lot more if there's share appreciation up to or beyond that out of the money strike price. So let's move on now and see what actually happened here. Okay, so on expiration Friday, KGC closed at $28.30. So the 27 strike was in the money. I allowed exercise, and what happened? 800 shares was sold at 27. Okay, that's kind of what I expected would happen. If I didn't want to sell the shares, I would have bought back the option before 4 p.m. Eastern time on expiration Friday. Now let's look at the out of the money 28.50 strike. That still expired slightly out of the money, right? Because KGC was 28.30 and the strike was 28.50. Well, those shares will not be sold. So we keep those 200 shares. So those were retained, but they were retained with a higher unrealized value at that point in time. We'll figure that all out in the next slide. So what was our initial cash outlay, Steve? Well, 1,000 shares, 27,600. That's how much I paid for the 1,000 shares. Now we had a loss on the 800 shares. I fully expected it. No big deal. All is well, right? Of $480. That's how much I lost on the sale of the shares. Now remember, that was made up for by the intrinsic value of the in the money strike that I sold. Now, what about the unrealized gain on the 200 shares I retained? That computes to $140. So net on the stock side, realized slash unrealized, I'm down $340. But let's have a look now, Steve, at the option side. My net realized premiums were $736. The 736 plus 50, right? 736 is what I took in on the in the money, and 50 is what I took in on out of the money. That netted me a gain on premium of 786. So when we take the 786 option premium and deduct the 340 net loss on the stock side, some of it is unrealized, that comes to a return of $446, as you see on the last bullet. And based on an investment of 27,600, that computes to a 5-day return of 1.61%. And that annualizes out to 84% based on 52 periods. It would be more if you based it on just 5 days. But I did it just to show you the lower, but yet still incredibly impressive return of 84% if we did this trade 52 weeks, not including weekends, just Monday to Friday trades. So, Steve, let's summarize in the next slide for Quasar members. We can generate significant returns with only 5-day covered call trades, even during holiday shortened weeks like this one was with New Year's Day in there. And we can craft these trades to align with our market assessment, our personal risk tolerance. And there is no law or rule that says they all have to be in the money or out of the money. We can ladder our strikes depending on which way we're leaning. In this particular case, I was leaning predominantly defensively. That doesn't mean I'm right or wrong. You know, other investors may view the market differently. That's okay, as long as your trades can align with your personal risk tolerance and your overall market view. Now, in this particular case with KGC, I think you saw from the numbers, we did get a significant 5-day return, and some of it had potential for more, and some of it had greater protection to the downside. And let me finally say, which I do at every single one of my presentations, Steve, is that covered call writing and cash secured puts are low risk trades. They are not no risk trades, because if your trade drops below your break even price points, we could start to lose money. And that's where our position management or exit strategy skill set must kick in. So I'm showing you trades here with great results and everything, but I want to let everybody out there know that you don't achieve higher than risk-free returns without incurring some degree of risk. And covered call writing, cash secured puts do have some degree of risk, but that degree is low. And everybody should know and understand that.
Yeah, and of course, obviously, everybody does due diligence, but in a time when the volatility is so high and in the news, we're finding ways of making money without even really having as much volatility and as much risk as you would normally just by playing the single-digit stock. So I really like this, Dr. Ellman. I appreciate this, and of course, as always, appreciate you being on Quasar Markets. And for those of you watching, I see quite a few out there today. We'll see you right back here with his next presentation on covered calls. So I'm excited about that. See you next time.
Thanks, Steve.